All right, legal structures. Everything in blue is what we call pass-through entities. What that means is the entity itself does not pay taxes, and the company may create a tax return, and the tax return, if there's multiple owners of that, the company will issue what we call K-1s. So let's say you have a company that does $100,000 worth of business, and it makes $10,000 worth of profit after all its expenses, all right? And we're 50% owners. I get a K-1 for $5,000, you get a K-1 for $5,000, half of that. Does the company have to pay me that $5,000? No. I'm obligated to pay that because the company made money. The company can do a distribution and give me that $5,000, or they can give me $1,000, which might cover my tax nut, and keep the other $4,000 for me to roll back into the business to buy more inventory, to scale, or go whatever the case is, just like any stock company. So they're not obligated to pay that money, but you, as an individual, are obligated to pay the taxes on the money that you didn't receive. Very similar to what happens in the stock market today. Right? When you own stock appreciation goes up, you made some money, but they reinvested it, and now you have a tax consequence for owning some stock, but you never saw cash from that to go off and do that. So typically what we do in small businesses is we figure out what the worst case tax nut is. We actually do that as a distribution to the individual so they're not out of cash. And then we'll carry the remaining portion, we call that retained earnings, and then we use that to help grow the business. All right, C Corps are the only ones that are ultimately going to be taxed as a separate entity. In many cases, that C Corp is being taxed at a lower rate than a high net worth individual would be. Now you have to remember, at some point, high net worth individuals paid 70-something% on their income. So every dollar they brought, 70-something cents went back to the government in taxes. Today it's not quite that high, but in many cases you've got to keep aware of where the tax dollars are going and what your tax rate is. But if I'm a high net worth individual, that dollar that comes to me through a pass-through entity, more of that goes out to taxes than somebody who is in a lower bracket. Somebody might be in a, let's say, a 15% tax bracket, and your high net worth investor might be in a 30% tax bracket. So that high net worth investor only keeps 70 cents out of that dollar and has to pay 30 cents to Uncle Sam, where you know, maybe in a 15, you get to save 85% of that, and only 15 goes to Uncle Sam. So you can see pass-through entities are good for kind of low income, but when you start dealing with high net worth investors, maybe that's not the way they want to go. But early on in the business loses money sometimes, right? Well, that high net worth investor might want to take that loss. By the way, when I'm a limited liability company or above, I don't issue shares of stock. I can divvy up that as much as I want. So I say, Mr. High Net Worth Investor, give me some money, and here's what we're going to do. For every penny that the business loses, you get to claim that, because I don't really need the loss, but you do. So I want you to be an early stage investor in my business, because we're not going to make money for a year, and you're going to have a huge tax write-off that's going to go in there. But in a year from now, the value of this company is going to be much better than it is now, and then you can sell your stake to somebody else who's interested in the cash flow thing. So why don't you just take advantage of the negative cash flow that we have. It's no cost to you at this point. You've made the investment. You get to claim that. Then you sell it at a higher price. You see, that becomes a viable messaging for an investor that's going to go in an early stage investment, because they get to take that write-off. Do they get to do that when they invest in the stock market? No. You see what I'm getting toward? Everybody knows somebody who's willing to be an investor in a particular business. And the C Corp, at the end, the dividends that C Corp pays is taxed at capital gains taxes, 15%. That's a whole lot less. So if I'm a high net worth investor and I'm investing in a C Corp, I'd rather take those distributions and pay 15% than the 30.